Business finance. Meaning of business finance. Business finance is the cornerstone of every organization. It refers to the corpus of funds and credit employed in a business. Business finance is required for purchasing assets, goods, raw materials, and for performing all other economic activities. Precisely, it is required for running all the business operations. The importance of business finance is evident from the fact that business finance is required to undertake every business operation successfully. The amount of capital that is pooled by a business owner into their company is often not enough to meet the financial needs of a company. Herein, the importance of business finance and its management rises even more. Consequently, business owners, along with their teams, look out for various other ways to generate funds. A business may require additional funds for anything ranging from buying plant or apparatus, raw materials, or further development. Different types of business finance are fixed capital, working capital, diversification, and technology upgrading. Importance of business finance. Here are some reasons why business finance is important for all organizations. Maximization of wealth. Business finance ensures that a shareholder's wealth is maximized. It is also important to understand that wealth maximization is different from profit maximization. Wealth maximization is holistic and ensures the growth of an organization. Ensure constant availability of money. For any business to survive, it should be in optimum financial condition. This includes the availability of funds at the time they are needed. Unless there are enough funds, the business may not be able to function properly. Attaining optimum capital solution. This requires a perfect combination of shares and debentures. This way, the organization will be able to maintain a perfect balance and not give away too much equity. Effective utilization of funds. This is another reason for the high importance of business finance and its efficient utilization. A business should be able to cut down unnecessary costs and not invest funds in assets that are not required. An exhaustive course in financial management, diploma in banking and finance, or any other course related to finance can give your career in financial management a head start. Or if you are already in the field, it can give your career the necessary boost. What is financial management in business? Financial management can be defined as the activities involving planning, raising, controlling, and administering money that is used in the business. Financial management involves procuring funds for buying fixed assets, raw materials, and working capital. Now that we know what financial management is, it is also important to understand that proper financial management helps businesses supply better products and services to customers besides offering other benefits. Methods of finance. No business can be carried without funding. In identifying suitable sources of finance, there are three broad categories. These are short, medium, and long term. Short term finance. Definition. Short term refers to the time period of less than 12 months, the current fiscal year. Examples of external short term finance include family and friends, overdraft, trade credit, debit, factoring, and microfinance providers. Amount short-term finance deals with a rather small amount of money. Purpose mainly for revenue expenditure. Most short-term finance is used to help a business maintain positive cash flow and help manage cash flow problems. It will be used to purchase raw materials, pay wages to production workers, pay trade credit, taxes, interest on a bank loan, etc. Medium-term finance. Definition. Medium-term refers to the time period of more than 12 months but less than 5 years. Examples of external medium-term finance include hire purchase, leasing and sale, and leaseback. Amount. Medium-term finance deals with fairly larger amounts of money. Purpose mainly for lower capital expenditure. Most medium-term finance is used to purchase cheaper fixed assets such as machinery, equipment, vehicles, etc. Long-term finance. Definition. Long-term, either debt or equity, refers to the time period of more than 5 years. Examples of external long-term finance include long-term bank loans, mortgage, debentures, bonds. Borrowing for long-term means that the business does not expect to repay this debt in less than 5 years. Amount: long-term financial deals with every larger amount of money. Purpose: mainly for higher capital expenditure. Most long-term finance is used to purchase expensive fixed assets such as land, building, assembly lines, etc. The longer the time period, the harder it becomes to plan effectively. Some business activities need huge amount of money and the business will invest this money over several years. For example, building a new factory, international expansion, or acquiring or taking over another business. Different business organizations consider the length of the time differently. It is important to remember that these definitions tend to vary between countries, industries, and even businesses. What is important is how these definitions link to the overall business aim and business objectives of the business. Firms that are heavily involved in research and development (R&D), such as space technology or pharmaceuticals, might view the medium term as 10 years, whereas fast-paced industries such as IT, information technology might see 5 years as a relatively long term. Therefore, business analysts do not have a common definition for the short-term finance, medium-term finance, and long-term. International finance. International finance, sometimes known as international macroeconomics, is the study of monetary interactions between two or more countries, focusing on areas such as foreign direct investment and currency exchange rates. International finance deals with the economic interactions between multiple countries rather than narrowly focusing on individual markets. International finance research is conducted by large institutions such as the International Financial Corporation (IFC) and the National Bureau of Economic Research (NBER). Furthermore, the US Federal Reserve has a division dedicated to analyzing policies germane to US capital flow, external trade, and the development of global markets. International finance analyzes the following specific areas of study: the Mundell-Fleming model, which studies the interaction between the good market and the money market, is based on the assumption that price levels of said goods are fixed. International Fisher effect is an international finance theory that assumes nominal interest rates mirror fluctuations in the spot exchange rate between nations. The optimum currency area theory states that certain geographical regions would maximize economic efficiency if the entire area adopted a single currency. Purchasing power parity is the measurement of prices in different areas using a specific good or a specific set of goods to compare the absolute purchasing power between different currencies. Interest rate parity describes an equilibrium state in which investors are indifferent to interest rates attached to bank deposits in two separate countries. Financial Institution in India (ICICI). Industrial Credit and Investment Corporation of India, that is ICICI, is a financial institution in India and was established in 1955 as a public limited company. The Indian Company Act governs it. ICICI is incorporated for developing medium and small industries of the private sector. Initially, the equity capital of ICICI was owned by companies, institutions, and individuals. At present, it has been owned by public sector institutions like banks, LIC, CIC, and its associated companies. In March 2002, the ICICI merged with the ICICI Bank and became a first universal bank in India. Due to this merger, ICICI does not exist anymore as a financial institution. Industrial Finance Corporation of India (IFCI). Industrial Finance Corporation of India is actually the first financial institute the government established after independence. The main aim of the incorporation of IFCI was to provide long-term finance to the manufacturing and industrial sector of the country. Let us study more about IFCI. Initially established in 1948, the Industrial Finance Corporation of India was converted into a public company on 1st July 1993 and is now known as Industrial Finance Corporation of India Limited. The main aim of setting up this development bank was to provide assistance to the industrial sector to meet their medium and long-term financial needs. The IDBI, Scheduled Bank, Insurance Sector, Co-ops banks are some of the major stakeholders of the IFCI. The authorized capital of the IFCI is 250 crores and the central government can increase this as and when they want to do so. Functions of the IFCI. First, the main function of the IFCI is to provide medium and long-term loans and advances to industrial and manufacturing concerns. It looks into a few factors before granting any loans. They study the importance of the industry in our national economy, the overall cost of the project, and finally the quality of the product and the management of the company. If the above factors have satisfactory results, the IFCI will grant the loan. The Industrial Finance Corporation of India can also subscribe to the debentures that these companies issue in the market. The IFCI also provides guarantees to the loans taken by such industrial companies. When a company is issuing shares or debentures, the Industrial Finance Corporation of India can choose to underwrite such. It also guarantees deferred payments in case of loans taken from foreign banks in foreign currency. There is a special department, the Merchant Banking and Allied Services Department. They look after matters such as capital restructuring, mergers, amalgamations, loans, syndication, etc. It is the process of promoting industrialization. The Industrial Finance Corporation of India has also promoted three subsidiaries of its own, namely the IFCI Financial Services Limited, IFCI Insurance Service Limited, and IFIN. It looks after the functioning and regulation of these three companies. Industrial Development Bank of India (IDBI). IDBI is the Industrial Development Bank of India set up in the year 1964. Its headquarters are in Mumbai and its parent company is Life Insurance Corporation (LIC). The purpose of setting up the IDBI is to financial and other credit facilities to struggling industries. Moreover, the IDBI came into existence with the aim to provide financial support system to needy industries. Initially, the IDBI continued to operate as an RBI subsidiary, but over time the RBI it underwent a transfer and now functions under the Government of India. SFC State Finance Corporation. The State Finance Corporation SFCs are in an integral part of the institutional finance structure of a country, where SEC promotes small and medium industries of the states. Besides, SFC helps in ensuring balanced regional development, higher investment, more employment generation, and broad ownership of various industries. At present, in India, there are 18 state finance corporations, out of which 17 SFCs were established under the SFC Act 1951. Tamil Nadu Industrial Investment Corporation Limited, which is established under the Companies Act 1949, is also working as a state finance corporation. Financial security is a type of financial asset that holds value and can be traded in financial markets. They are usually issued by governments or companies and are used to raise capital to finance operations and growth. Securities often trade on a secondary market, with buyers and sellers trading securities between themselves. These transactions involve a variety of laws and regulations designed to protect investors and ensure fair and transparent trading practices. Financial securities are subject to market risk, meaning their value can fluctuate quickly and dramatically in response to changes in the economy, politics, and other factors. As such, investors who buy securities are exposed to both the potential for gain or loss, depending on the performance of the. What is a security? The term security refers to a fungible, negotiable financial instrument that holds some type of monetary value. A security can represent ownership in a corporation in the form of a stock, a creditor relationship with a governmental body, or a corporation represented by owing that entity's bond, or rights to ownership as represented by an option. The market in which securities are issued, purchased by investors, and subsequently transferred among themselves is called the securities market. The securities market has two interdependent and inseparable segments, viz. the primary market and secondary market. The primary market, also called the new issue market, is where issuers raise capital by issuing securities to investors. The secondary market, also called the stock exchange facilities, trade in already issued securities, thereby enabling investors to exit from an investment. The risk in a security investment is transferred from one investor to another, seller to buyer. In the secondary markets, the primary markets create financial assets and the secondary market make them marketable. Types of securities. There are two main types of securities, equity and debt. Equity securities. These represent ownership in a company. When an investor buys equity securities, they become a shareholder of the company. Shareholders are typically not entitled to regular payments, although equity securities often pay out dividends. In the meantime, they are able to profit from capital gains when they sell securities, assuming they have increased in value. Debt securities. These represent a debt obligation usually issued for a fixed period of time. When an investor purchases a debt securities, they are lending money to the issuer, corporations, governments, and other entities, in exchange for regular interest payments and a return of the principal amount at maturity. Securities examples: stocks, bonds, mutual funds, exchange rate traded funds, derivatives, and hedge funds. Participants in the securities market. Participants in the securities market are individuals or institutions that play a role in the buying and selling of securities. These participants can be organized into two categories: primary market participants who are responsible for issuing securities, and secondary market participants who are responsible for trading securities already issued. Primary market participants include investment banks, governments, and corporations. Investment banks act as intermediaries between issuers and investors. They assess the underwriting risk of an issuer, and if they decide to take on the risk, they will bring the issuer to the market and work to secure the necessary funding. Governments and corporations can also issue securities directly to the public without an intermediary. Secondary market participants include retail investors, institutional investors, and broker-dealers. Retail investors can purchase securities through their retail brokers or directly from the issuer. Institutional investors are large investors such as mutual funds, hedge funds, or pension funds. They usually purchase large amounts of securities directly from issuers or in the security secondary market. Broker-dealers are firms that act as both brokers and dealers. They buy and sell securities on behalf of their clients while also trading for their own account. Thank you.